Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
This is the ETF Market Insights webinar. Thank you so much for joining us again. Thanks to our audience who are here live today on Friday afternoon, and thanks to everyone on our YouTube channel who are tuning in as well. Well, we get started always with our disclaimer slide. So as a reminder to our audience, we're not providing any recommendations today. We're not providing any advice. Today, we are focused on talking about inflation and educating our viewers and our audience about what this environment looks like and how we can use ETFs to hedge against inflation in our portfolios. I'd also like to remind everyone, any performance numbers or distribution numbers that we reference today are speaking directly to today, January 21st, and those numbers can move and change. Well, we have a really fun panel today. So Alfred Lee, Director and Portfolio Manager at BMO ETFs, is joining us. And Steve Shepard, Portfolio Manager over on our multi-asset team at BMO Global Asset Management, are both here today to guide us through this hot topic of inflation. Now, this is a great tool. I've showed it in past episodes, but inflation numbers were just released in Canada this week. 4.8% is the number. That's quite high. That's the 12-month change. We're looking at about a 3.4% annual average CPI. So you can get all these numbers at Statistic Canada, and you can even go a little deeper here. So they actually have an inflation calculator. So if inflation is something you want to learn more about how it is impacting your monthly expenses and your portfolio, you can actually plug in here all your expenses and see how they are all affected individually by monthly CPI and how that changes. So give that a look if you're interested in learning more about inflation and how it impacts you. Now, getting this conversation started, I think it's worth going through a couple high-level definitions so we're all on the same page. So when we talk about inflation in Canada, the most referenced number that we look at is CPI. It's the Consumer Price Index. So Steve, can you give our audience members, give them a little 101, what is CPI and what is it exactly is it telling us?
Sure, thanks very much, Danielle. CPI, the Consumer Price Index, is a calculation done both in Canada and the US, which basically measures the month-over-month and year-over-year changes in the prices of several components of basically the total economy. The best way to think about it is the average shopping basket of a Canadian. The two key distinctions that aren't apparent on this chart here is you'll probably hear the terms quite common: headline versus core inflation. And the big difference between headline and core is food and energy. Core excludes food and energy, as historically they have tended to be the more volatile parts of CPI, as opposed to the stickier components such as housing costs, goods, and services. Now, the past year has been certainly an anomaly with the global pandemic, as we've seen some very surprising numbers in smaller components. But ordinarily, you want to think about CPI in terms of what prices have been increasing over the past 12 months that's really increasing your cost of living. Now, obviously, housing is one of the biggest components of consumer CPI, whether that's your mortgage payment or something called owner's equivalent rent. In terms of headline inflation, which is the number you quoted earlier, that's been driven for a large part by energy, which of course is excluded from core inflation. But as I like to say, if you're not worried about food and energy prices, that probably means you don't eat and you walk to work. The average person has to worry about those two things. So really what you have to think about is not just what the overall level is, but more importantly, what is driving that number, and is it a large number in a small component or a moderate increase in inflation in a very important component like housing or goods and services or all of the things that you consume on a regular basis.
That's great. Thanks, Steve, for talking us through that, and also the differences between core and headline inflation. I think that's really important for people to understand when they're looking at these numbers. Now, there's also another metric that we tend to look at a lot, and I know a lot of direct investors at home don't have access to a number like a break-even rate, but it's something we reference a lot in these presentations. So Alfred, can you kind of give us high level a definition or explain what the break-even rate is and how it tells us a little bit about inflation?
Sure. So the break-even rate is essentially more of a forward-looking measure in terms of what the market anticipates inflation to be. So the way I look at it is essentially CPI is essentially a backward-looking measure of what essentially happened, whereas the break-even rate is a forward-looking expectation. So it's what the market is priced in terms of what they think inflation will be in the future. So the way they calculate this is essentially taking the difference between an inflation-protected security. So in the US, they use TIPS. In Canada, they use real return bonds, and they take that difference in yield versus a nominal bond. So that difference is essentially what the market is pricing in terms of inflation. So the good thing about a break-even rate is that you could have a break-even rate for different time periods. So you could have a 2-year break-even, a 5-year, 7-year, 10-year, so on and so forth. So you could essentially have inflation expectations across the yield curve. So it's argued that the break-even rate potentially is more accurate, given that it is priced by bond traders, bond portfolio managers, those people that are in the market, so essentially market practitioners. So because there's money on the line, they assume that it is a more realistic measure in terms of what inflation is expected to be. So the best way to use this is essentially what the market is pricing in. So let's say, for example, if the 10-year break-even comes in at 2% and you believe CPI is going to come in at 3%, then you're better off in owning a treasury inflation protected security or a real return bond. That's because the market is essentially underpriced inflation. And on the flip side, if sticking to a 2-year break even again, or sorry, a 2% break even again, if you anticipate CPI to come in lower than 2%, then the market is an underpriced inflation. So you're better off in being in a nominal bond.
That's great. Thanks for walking us through that. And just looking at this chart here, this is the 5-year, and it's about, I'm eyeballing here, around 2.8% for that break-even rate. And then we just looked at those CPI numbers, 4.8% there with that backward-looking metric. So 2 really interesting numbers to look at when we're trying to evaluate inflation. So, what's causing inflation today? There's a lot going on to get us to that 4.8% CPI number. So, Steve, can you walk us through some of the high-level macro themes that are really driving that inflation number up?
Yes, I think first and foremost, just to provide a bit of background, historically speaking, inflation is typically the mandate of any country's central bank to try and maintain a target level of inflation. And for the past decade or so, the target of the US Federal Reserve, for example, and Canada, has been roughly around 2% inflation. And the economy has had a very hard time maintaining that target up until the global pandemic. Now, obviously, everybody recalls with the onset of COVID in the first quarter of 2020, we had a global recession, which was a function of us basically shutting down our economies and staying home and sheltering in place. And what that led to was a decline in the cost of a lot of goods and services, because obviously nobody was going out shopping, nobody was going to restaurants and getting their haircut. The list goes on, but just as an example, the futures price on a barrel of oil fell to minus $10 a barrel in April of 2020. So fast forward to 2021, and what we experienced was that year-over-year bounce back from a declining economy to a rapidly opening economy. And what that led to was spikes in demand that drove prices much higher. Now, at the top of this chart, you'll see monetary stimulus. The money supply in the US, for example, was growing at over 25% year over year with all of the stimulus that was put in by bringing rates down to rock bottom, almost zero. And along with that, the quantitative easing, which was the central bank transactions in the bond market, which I'm sure Alfred could speak to a little bit more. But in terms of that monetary supply, when there's more money in the system, you would expect inflation to kick in. Now, the real interesting thing is that on top of that loose monetary policy, we had very strong fiscal support from governments around the world, whether it was unemployment benefits or additional spending, or just supporting various businesses and parts of the economy that had to shut down entirely. That combination of monetary and fiscal policy is typically a recipe for higher inflation. Now, what compounded that, and energy prices, again, that's a very good example. When you've got oil going from minus $10 a barrel to where we are today, I think we cracked $80 a barrel this week or last week. You can see that obviously that is a very large number in terms of an increase that has led to a year-over-year contribution to headline inflation in the US that cracked 7%. But this has been compounded by the fact that as a result of the shutdown and ongoing issues with the Omicron variant and border closures and a number of sector-specific incidents, that we've got various supply chains around the world that are facing a number of problems in terms of securing goods. Demand is very strong because there's a lot of money floating around. Money is cheap to borrow as well. And not only that, people have more money saved up in their bank accounts than they have in over a decade because they simply haven't been going out spending it, whether it's on vacation or traveling or what have you. Finally, we do have an issue with skilled labor supply. And even though we've added a number of jobs back, in the case of Canada, we're actually back to above pre-pandemic levels in terms of employment. The US is still lagging by a couple of percent below where we started from at the end of 2019. But there are more job openings than we have seen in a very long time. So it's not that people can't get a job, it's finding the right people for the right job. And that's led to a labor shortage, which is driving wages. And there is some concern that that might fuel a wage price spiral that will further contribute to inflation in the future. So there's a lot of things that are kind of a perfect storm for higher inflation in the shorter term, and it's led to some market volatility around that.
A perfect storm. That's a great way to describe what's going on right now. Steve, let's stick with you for a second and this theme. So here's a couple, just kind of diving deeper on some of those topics you just talked us through. Here's some data to support that. What can you tell us about these data points here on this slide?
Sure. These are some, the two on the right are some pretty popular charts from the media, whereas the one on the left is what I was referring to. This is actually Canadian oil, Western Canada Select. I was quoting WTI, which is West Texas Intermediary. The other measure popular is Brent crude, which is more international markets in Europe. But you can see that crude prices for Western Canada Select, if you look at the just in 2020, how that price cratered to, just above zero. Obviously, on a percentage basis, that is a massive increase in the cost of oil, and therefore anything fuel related, whether it's diesel, gasoline, airline fuel, maybe not as much because it's not in as strong a demand. But the reality is that we're actually driving around and going places more. Compound that with the fact that there's been several years of underinvestment in capital expenditures, not just in Canadian oil, but in oil around the world, as a result of the ongoing focus on ESG themes and electrification and carbon reduction. Oil has once again become undersupplied relative to global demand, and that's driving inflation. The middle one is quite interesting. It costs more to buy a one-year-old Ford F-150 than it does to buy a new one, because quite frankly, people are impatient. They don't want to wait the 6 to 9 months that it takes to get a new car, because the semiconductors, the chart on the right, that go into those cars are in short supply. And this is actually affecting everything from cars to washers and dryers that are now computerized. Pretty much anything with a semiconductor has been facing this supply shortage. So it's not that there is a shortage of goods, there's a shortage of goods that people actually want. If you want a new car, there's lots of new cars available. You just don't get to pick what color, what features, and what toys are in the dashboard if you want to get it. And that's why people are looking at cars that are 1 year old, because they have the features that they want. And right now, people have more money to spend on the things they want than they have in a long time. So it's this interesting conundrum of people wanting to spend more money. That typically leads to inflation, but a lot of the COVID effects are still overhanging a number of sectors. I mean, we even had supply shortages driven by the fact, I can't remember the name of the ship, but it was basically the world's largest container ship that blocked the Suez Canal for about 8 weeks. Our just-in-time global inventory is absolutely, glass-like fragility. If you see a couple weeks worth of upset, all of a sudden that disrupts even the simple availability of shipping containers. That adds into the total cost of getting the things you want, where you want them, and when you want them.
So many interesting points there, and I will highlight this is a global phenomenon. I don't know if we've ever really seen these types of supply shortages before, but these are impacting not just Canada, not just North America, but globally.
Well, one last point just of interest by way of example, the Port of Los Angeles, I think at the peak, it might have come down since the peak, but basically they had ships waiting in the harbor, waiting to unload, that represented 85 days of unloading time just to clear the backlog. So you can imagine what kind of capacity increase would be required to remove that backlog in short order. It is an indication that it's probably not going to be done in the next month or so.
Yeah, great point there. So many backlogs, and obviously this is really putting a lot of upward pressure on that inflation number. A couple more data points here, Steve, for you to talk us through. Now, this is focused more on the labor shortage and the cost of wage. How is this impacting the inflation number?
Yeah, I mean, it's very clear on the chart. You can see that on the left, you're looking at US hourly wages versus Canada. It's interesting that Canada is actually lagging the US, given that we've done a better job of creating more jobs. But there's a number of factors that are going into this labor shortage, and not all of them are just, people are hesitant to get back to work. There's a lot of people that do want to get back to work, namely single parent households that haven't been able to return to work due to school shutdowns, for example. And that's something that's near and dear to our heart here in Ontario. Kids are getting back to school in person now, but simple things like that have been detracting from the total labor force. So we're seeing that upward swing in hourly earnings year over year, but on a real adjusted basis, wages are actually are still negative because of that high headline number that we're seeing in the US and Canada. On the right, you're looking at a chart that basically looks at the total employment rate. And even though we've recovered from the pandemic lows, you can see that we're still not quite back to where we were pre-pandemic. And that's basically the broad measurement of the labor force, everybody above 15 or 16 years. This is otherwise known as the participation rate, and it can float around. If you recall, after the global financial crisis, we saw several quarters of increasing employment, and yet the unemployment rate would go up. And that was because people were leaving the workforce. So that tends to bounce around. But the clear message from this chart is that there is still ground to be made up, getting people back to work to the degree that we had prior to the COVID pandemic.
Thanks for walking us through that. Now, how does this all kind of come back to our portfolios? So we kind of set the stage, and thanks Steve and Alfred for doing that on a macro level, what's driving inflation. But now let's think about our investments in our portfolios. So Alfred, we know that the fixed income side of the portfolio is way more exposed to rising inflation. So can you talk us through how does inflation impact fixed income and impact bonds?
Sure. So for fixed income investors, typically outside of default, inflation is probably one of the worst scenarios for fixed income investors. So the way to think about this is, let's say if you make a $10,000 investment into a bond that's going to pay you back in 10 years, it's going to pay you a fixed coupon. If you have inflation in 10 years time, that $10,000 is going to be worth a lot less. So, for fixed income investors, again, outside of default, inflationary pressures tends to erode, the value of a dollar. And because they're, in terms of fixed income instruments, it doesn't offer you any growth to offset that inflationary pressure. That's why fixed income tends to underperform in an inflationary environment.
Thanks, Alfred. And what we're looking at here, just to give our audience an idea of this chart, we're looking at the Government of Canada 5-year bond and a US Treasury 5-year. And, back in 2000, these bonds were yielding north of 5%, which is kind of crazy to think where we are now. The 5-year Government of Canada bond yielding about 1.7%. So when you think about inflation north of 2, north of 3 or 4%, this can be a challenging environment for investors. So Alfred, you gave us a good rundown on the fixed income side of the portfolio. So what about equities? Are they better protected, or how does inflation impact equities?
Yeah, so this is a backtest that I put together. Obviously, in the last 10 to 20 years, it's been very hard to isolate periods in which you had sustained inflation. So what I did was I just took the daily move in the 10-year break-even. So the break-even is the implied inflation that I spoke about earlier. So I basically just took the day over day change in the 10-year break-even, and then I compared it to the daily moves in various asset classes. So the S&P 500, obviously representing US equities, the TSX composite representing Canadian equities, the FTSE TMX being Canadian bonds, and then a commodity index and also spot gold. So that being spot gold, the actual commodity and not gold stocks. So how you read this table essentially is, the top part of the table is essentially deflationary periods, and the bottom of the table is essentially inflationary periods. So this is a good proxy in terms of, getting a good indication in terms of how asset classes will perform in various, deflationary and inflationary environments. So in a deflationary period, no surprise, equities are going to underperform. Bonds are going to outperform. Just going back to the example that I gave before, in a deflationary environment, if you invest $10,000 and the value of your dollar is going down, that $10,000 is going to be worth more, 10 years down the road or whenever you get that principal back. No surprise, commodities underperformed. Gold actually outperformed just because, whenever there's deflationary pressures, there tends to be a lot of macroeconomic risk as well. But on the flip side, so looking at the bottom of the chart, during times of inflation, equities actually outperform even commodities. And when you look at bonds, as I mentioned before, obviously bonds will underperform, in an inflationary environment. And then gold is also, used as an inflationary hedge as well. So, again, I think this is a good proxy just in terms of knowing how various asset classes perform in both a deflationary and an inflationary environment.
So Alfred, thanks for walking us through that, the fixed income side and the equity side of the portfolio. So let's turn back to fixed income for a second. So you said that inflation is generally not good for fixed income. However, there are products out there that investors can use to hedge against inflation. Can you tell us what those products look like, or what's a good inflation hedge for a fixed income portfolio?
Sure. So there's inflation protected fixed income, so US TIPS in the US and real return bonds in Canada. Mechanically, they work in the exact same manner. So how they work is essentially the principal value is essentially tied to the CPI. So the CPI is the measure of inflation that Steve referenced at the beginning of the presentation. But essentially, let's say if you've invested, $100,000 in US TIPS or real return bonds, and there's a 2% CPI that just registered, the value of that principal value is going to get grossed up by 2%. The coupon doesn't necessarily change, but because the coupon is, in terms of what you receive in pocket is essentially the coupon rate times your principal value, you are getting more coupon just because the principal value has grown. So essentially, U.S. tips and real return bonds are designed to offset, some of that inflationary pressure. That's why we've seen a lot of interest in both U.S. tips and real return bonds. Structurally, however, the market is a little bit different where, U.S. tips, there's various issuance across the entire yield curve. Real return bonds, however, most of them that are issued in Canada do tend to have very long term to maturity. So they do tend to have much longer durations. So there's two ETFs that allow investors to get exposure to both of these markets. The US tips with ZTIP. So this one essentially focuses on the short end of the curve. And why it focuses on the short end of the curve is because during an inflationary environment, you may expect the yield curve to steepen. So you may want to avoid the long end of the curve. So by focusing on the short end of the curve, it essentially allows investors to get more of a pure play in terms of that inflationary benefits by, again, avoiding the long end of the curve. Also offered in many different formats. So .F offers, or the .F version is essentially a currency hedge version. So again, for fixed income investors that want a pure inflationary hedge, this also negates the impact of currency as well. For ZRR, that is the Canadian version. So this focuses on the real return bond market. So again, as I mentioned before, with the real return bond market, most of the issuance is on the long end of the curve. So it does come with a much longer duration than ZTIP.
Thanks for telling us about those products, Alfred. And I do want to highlight the duration on these. So when you are out there thinking about adding a inflation hedged ETF to your portfolio, do your research and look at that duration, because of course a longer duration ETF will introduce duration risk, and that could offset the inflation risk. But again, if you do have long bonds in your portfolio, that's something you want to, that's part of your strategy and you want to replace, you can look for that longer duration product as well. So thanks for talking to us about those ETFs. Now let's turn to the equity side of the portfolio. So you kind of talked to me earlier about a few ideas you had for inflation hedging equities. This first is more about a broad market approach. Can you talk us through that, Alfred?
Sure. So quality is a factor that typically does perform well during an inflationary environment. And the reason why is because when we screen for quality companies, we're screening for three specific metrics. So we're screening for high return on equity, low financial leverage, and low earnings variability as well. So because we are screening for high return on equity and low earnings variability, what that means is we typically end up with higher quality companies, blue chip companies that tend to have stronger balance sheets. So think of this as, these blue chip companies tend to have competitive advantages in their respective fields. So during inflationary periods, what they tend to have is, better pricing power, where if there's, higher input costs, they tend to have a better ability in, passing on those higher costs to the end consumer. So they're, in terms of their balance sheets and income statements, they're better protected. In addition to that, because we screen for companies that have low financial leverage, meaning that they use less debt, typically in an inflationary environment, what comes after is higher interest rates. So because they carry less debt, they tend to be less exposed to higher interest rates as well. So we do offer a number of quality ETFs. So focusing on the US is ZUQ, and we do have the number of different variants of that. So in US dollars and also currency hedged as well. And ZGQ is the global high quality, which is essentially a one ticket solution of getting exposure to global blue chip securities.
Now, what about a sector rotation approach? I know that there are some sectors that will outperform in inflationary environments. Can you talk us through those?
Sure. So a number of sectors, for example, energy, as Steve mentioned, we're seeing a lot of inflationary pressure in energy because energy and oil and gas typically is quoted in US dollars. Typically in inflationary environments, commodities perform well for that reason. So in addition to that, as Steve mentioned, there tends to be, right in terms of right now, there's very little capital expenditure spent in terms of traditional fossil fuels, which is creating additional upward pressure in terms of energy prices as well. Real estate tends to be a good inflationary hedge as well, just because real property tends to appreciate during inflationary times. So think of this as, as your own house, for example. If you bought it for $1 million in times of inflation, if prices have gone up by 20%, all of a sudden you're not going to sell your house for $1 million. You're going to demand $1.2 million to sell your house. So typically, real property tends to be a good inflationary hedge for inflation. And also banks tend to be a good inflationary hedge as well, just because banks tend to do well whenever there's a steeper yield curve. Typically when there's an inflationary environment, what happens is, banks tend to borrow on the short end of the curve and they lend on the long end of the curve. So typically in an inflationary environment, banks tend to do well because of that steeper yield curve.
Thanks, Alfred. And we have some ticker symbols down there for you, for the audience to check out if they're thinking about a sector rotation strategy to hedge inflation in their equity portfolio. Okay, Steve, Alfred, you can't leave yet. We have a few questions, so thanks to everyone who sent these in. The first one, I'm very interested in learning more about investment strategies for international investment opportunities. This particular viewer is also worried about a little bit of market volatility with COVID. What are your thoughts on this one?
Sure, I'll go first. I mean, international opportunities, I think if you look at relative valuations, there's some compelling opportunity, particularly in Europe and Japan relative to the US, which has really been a dominant outperformer. First during the pandemic, the technology sector, representing close to 30% of the index, has been really a driver. But as we've seen inflation, really kick in here, looking across the globe for better value opportunities has really been something that the market's been turning towards. In addition to styles and sectors outperforming, what we have seen is that value has really started to pick up, and that is expressed either through cyclicals, whether it's energy or financials, or quality is very close in terms of different factors to value. But with higher inflation come higher rates, which means that you might be experiencing some multiple compression. So if your portfolio is composed entirely of high price earnings ratio positions or exposures, you might want to look to something like ZEA for MSCI EAFE exposure. Emerging markets, they're even more attractive on a valuation basis, potentially a little bit more volatile in the shorter term, given some of the difficulties that China has been experiencing. But I would say looking regionally outside of North America on a longer term basis does offer some interesting value, and especially just focusing on that value factor as well overall on a global basis would be a couple of strategies I think someone should consider.
Great, thanks, Steve. That was a great answer. Okay, we have a fixed income question. This one's about US high yield bond ETFs. This audience member wants to know, are there opportunities in US high yield bonds? And they're looking at about a 3 to 5 year time horizon. Alfred, what do you think about this one?
Yeah, we have seen a lot of money flow into high yield bonds as a sector in the fixed income market, just because of the yield. So even though yields have been going up, we still live in a relatively low yield environment. So a lot of fixed income investors have been stretching to get additional yield in their portfolio. So high yield has been an area or a natural landing spot in which they allocate to. In addition to that, during times of inflation, high yield is going to offer a more positive real yield to offset some of those inflationary pressures as well. Looking out 3 to 5 years, obviously it's tough to tell, but right now we are seeing a lot of money flow into high yield as a sector in the fixed income space.
Now, sticking with this theme, we actually have another investor out there asking about U.S. high yield bond ETF. Seems to be a popular topic. But this question's about, what do? Do you hedge it, or do you unhedge that exposure?
I'm going to go to my default answer for tough questions and say it all depends. If you're looking at U.S. high yield bonds in isolation, there's an argument to be made that, high yield bonds are, I would say towards the risk asset side of things, as opposed to a government bond being a more defensive asset base. And by having an unhedged exposure with some US dollar exposure as a Canadian investor, the US dollar tends to be a risk off asset class. So that kind of gives you a little bit of a barbell effect, but I'm assuming that the average investor is buying this in a broader portfolio. In which case I would suggest that if you have a balanced to equity heavy portfolio, you probably want to go with an unhedged ETF. A hedged ETF, because you don't want to commingle your US dollar exposure with your credit or duration exposure of your fixed income sleeve of your total portfolio. If you are managing or holding a portfolio that is predominantly fixed income, again, a little bit of a difference. If you don't have any other US dollar exposure from equities or some other asset class, you might want to have the unhedged version of the US high yield bond ETF, just to provide that little bit of currency diversification in your portfolio with some US dollar exposure.
Thanks for that. That was a great answer. Thanks, Steve. Thanks for all the questions that came in. Please keep them coming. Next week, we have a market maker joining us. They can take your questions, even any questions about, what is a market maker or anything about ETF liquidity. We'll take those questions, or anything at all. We'll take off-topic questions as well. So keep them coming. And we hope to see you next Friday, January 28th, for that session with market makers and ETF liquidity. Thanks for tuning in, and we'll see you then.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.